Between October 18th and December 27th, U.S. two-year Treasury yields collapsed from 5.22% to 4.25%. Now, this represents the second sharpest drop since April of 2020. Only the collapse in March of 2023 during the wake of the SVB collapse was more severe. Now, the current drop in yields appears to be tied to the growing narrative that the Federal Reserve will probably be aggressively easing rates in 2024 in response to the drop in inflation. Now, the futures market is currently pricing in the probability of over 150 basis points of cuts this year, according to the CME FedWatch tool. Of course, everything could change this week as the highly anticipated non-farm payrolls number comes out on January 5th. Consensus expectations are for a gain of 170,000 jobs. Now, the labor market has been the source of great scrutiny, as 2023 showed a consistent pattern of better than expected headline data and of downward revisions as the months wore on. This has created some confusion among analysts as to the actual health and direction of the domestic labor market. Now, it's also worth noting here that we don't see the next round of inflation data until CPI on January 11th, and that probably makes the labor data more important as it fills the void. Now, if a trader believes that two-year yields could drop from here, they could express that by selling the January micro two-year contract at 4.22 and targeting a move to the psychological level of 4.00. Stop for this trade could be placed above at 4.38. This trade can make $220 if the target is reached and risks $160 if you're stopped out of your level. Now, if a trader believes that two-year yields could continue rising from here, they could buy the January micro two-year contract at 4.22 and target a move to the December highs of 4.74. A stop for this trade could be placed below at 3.90. Now, this trade could make $520 if the target is reached and risks $320 if you're stopped out of your level.